Alright, so today I am going to go over an illustration. I just want to give people an idea of what they're looking at whenever they look at one of these. This is a policy, this is on me. 11, almost 12 years old now. And I just want to give a general idea of whenever you look at an illustration, what are you looking at? So, in this case, like I said, it was, I paid this one already. I'm about to pay on this one here. What I want you to look at is you can see the total net cash value in the non-guaranteed column. That is including the dividends. So the guaranteed, as of right now, the way this policy is structured, it has a 4% guarantee, and then it has a dividend rate on top of that. And that dividend rate, depending on the company, could be 1 to 2%. Sometimes more. It just depends. Right now we're in a little bit lower interest rate environment. This is probably about, I'm guessing, 5 to or so, maybe a little more, but netting about 4.5. All these numbers are after any expenses. So any expenses with regard to an insurance policy are already accounted for whenever you look at these. So the guaranteed amount is here. Well, let's see, the guaranteed cash value for the end of the year. So it shows how much that is. And then it shows how much for the paid up additions or the paid up additional insurance that there is here. You can see when you add up these two, so let's just call that 40, that's about 98,000. It's basically the same amount at this point. But it shows the dividend here, what the dividend is paying each year, and that's a refund on premium. So anytime the insurance company has a surplus of money, then they report a dividend, and that dividend is actually considered a refund of premium, making that a tax-free, tax-free distribution to you, and that income to you is not taxable. So, and in this case, the other thing I want to point out is, so I usually pay more than, the way this is structured, I used to be able to put in a lot more money. But as of year 11, I can only double the 340910 for the most part. And I paid this. I usually still try to keep funding it as much as possible. But this 3409, if you look at it and you look at the difference from here to here. So you're looking at, let's look at it. The total net cash value and the non-guaranteed. So let's say it's 99,382. So that's 7,907. So let's just call it $7,900. So I paid this, but yet $7,900 is in there. So I more than doubled my money for the most part. Now with the paid up additions that I'll pay, there'll be even more of a gain. Not to mention that 340910 in addition to that I'll put in, that'll be available plus another small gain. So now if you go down, and let me see if it'll let me scroll here. And if you go to let's go to year 20, for example. Well, let's just go to retirement here. Let's just say age 65. So here is age 65 right here. This is the 31st year of the policy. If I were to retire at that time, hold on 1 second, I lost my place on this, I apologize. Here we go, it's this column right here. So let's go down to year 31, it's that 324 number here. So 324,180. So if I do 324,180 minus 309,448. So that gives me a gain of $14,732. So in retirement, if I pay this $34,0910, I'll have $14,732, meaning if you subtract my 3409.10, that gives me $11,322.90, and that's just from this one policy. So every single year, I'm going to find a way, even in retirement, to pay that premium because I get $11,000 for the year. Now, mind you, this is, I mean, the policies can be bigger. You know, there's all kinds of scale. These are ones that I was doing, you know, this one's older, so I did this one early on. I couldn't fund it as much. I can fund it, you know, quite a bit more now, and anything new going forward, I, you know, always do a higher amount, and, you know, I go from there. So, I mean, it's all going to be up to the individual. And, you know, referring to like the last video, it's all about the funding. You look at funding it. I'll probably show in a future video, you know, if you're basically maxing out your IRA at, I think it's $6,000 a year, if I'm not mistaken, what that looks like. What does that look like in a policy? Because this is in comparison, in some ways, it's a nice, boring, like, rate of return, and you know it's going to be constant. And, you know, whenever you're talking about infinite banking, I'll say it again, it's not necessarily a get rich quick scheme, but it ends up being a very nice tool. And, you know, you can really utilize it for a lot of things. And this is just one. This is one of 9 or 10 that I have. I think it's 10. And yes, the funding in the first 10 years was more money. But now, you know, I fund it as much as I can. So if I can double that, which they'll still allow, I'll double it. So yes, these numbers will go up with each year that I double that amount, because it'll still let me pay that much into the paid up additions, and it's just one time, 1x the base premium, which the base premium is at $34,0910. You know, and mind you, this structure, the way this policy is structured, the way I structure them now, they didn't necessarily allow you to structure them the way you can structure them now. So you can have even more liquidity, and with more liquidity, the way they're structured, you're able to lower you're even able to I won't say necessarily lower your insurance costs, but yes, in a way you do, and you can fund it more and still have a good death benefit, and because it's proportionate based on your age and the death benefit as to how much money you can put into it. But you can cram a lot more money in here, and if you do certain adjustments to the actual structure of the policy and engineer it right, you can really maximize that cash value. But anyway, hope this was helpful. Again, in the comments, please let me know if there's anything that is of interest or something you want to see, maybe even an illustration you want to see. And I will do my best to make a video about it. And please like, subscribe, and hit the notification bell. And I will catch you on the next one.